The biggest bank collapse in history happened in 2008 when Lehman Brothers, a venerable investment bank, filed for bankruptcy. To understand how this happened, we need to go back to the early 2000s. At the time, the housing market in the United States was booming. Lenders were offering mortgages to people who couldn't afford them, and borrowers were taking on risky loans in the hopes of making a profit by selling their houses quickly. These risky loans were bundled together into mortgage-backed securities, which were then sold to investors all over the world. Meanwhile, banks were getting creative with their finances, offering loans to people who had no business borrowing money. To make matters worse, the banks were using these loans as collateral to borrow even more money, creating a house of cards that was bound to collapse. In 2007, the first signs of trouble began to emerge. Housing prices began to fall, and many people who had taken out loans found themselves unable to pay them back. This led to a wave of foreclosures, which caused the value of mortgage-backed securities to plummet. Suddenly, investors all over the world found themselves holding worthless assets. Lehman Brothers was heavily invested in these mortgage-backed securities and other risky investments. As the value of these assets began to plummet, Lehman Brothers found itself in trouble. Despite attempts to raise capital and shore up its balance sheet, the bank was unable to weather the storm. On September 15, 2008, Lehman Brothers filed for bankruptcy. The collapse of Lehman Brothers sent shockwaves through the financial system. Other banks began to realize that they too were in trouble, and banks stopped lending to each other. This caused a freeze in the credit markets, which led to a global recession as businesses struggled to access the credit they needed to operate. The collapse of Lehman Brothers also had a profound impact on the regulatory environment. Governments around the world realized that the financial system was much more interconnected and complex than they had previously thought, and they began to implement a range of measures to try and prevent a similar crisis from happening again. Today, Lehman Brothers is remembered as a cautionary tale about the dangers of excessive risk-taking and financial speculation. The collapse of Lehman Brothers was a pivotal moment in the history of the global financial system, and its impact is still being felt today.